We continue part 2 of our interview on the latest financial reform proposal from the Senate Banking Committee. Does it address the problems that caused the crisis? Here are Michael Iannaccone of NDI Investments and Rebel Cole of DePaul University. Okay, guys, let's start with the credit rating agencies. Under this proposal, the Securities and Exchange Commission would have the power to regulate those, but it really doesn't stop Moody's and S&P, Standard & Poor's, from doing the exact same thing that they did during the last crisis, which was give AAA ratings to junk investment. Rebel?
Well, what will change now is that the investors know that they gave AAA ratings to junk investments, and I don't think the investors are going to trust them as they did in the past. And a lot of their ability was to pass this on to unwilling or uninformed investors around the world. Those investors are now going to be paying attention. So this may be a situation where the market will take care of itself.
Michael, what do you think? Do credit rating agencies, does this legislation go far enough to regulate those?
You know, the problem with the credit rating agencies and the public, or the investors, is two things. One, just because you have a AAA rated bond on a municipal bond, it's not the same thing as a AAA rated rating on a mortgage-backed security. You have to read the difference between those two different ratings. The second thing is, so that's from the investor's point of view, and my thought process on all this is the reason that we had a problem with the credit rating agencies is that they became advisors on the deals with the investment bankers on showing them how to structure the deal to get the AAA rating.
So that needs to be separated, right?
Separated. You shouldn't allow them to do it, and they don't do it anymore. They took that power away from them to give them back credibility. You can't structure the deal and then say you're being objective about the deal on in the same breath. So.
All right, let's move on to the shareholders' rights. Now, I read this part, and I'm like, is this a joke?
Oh, it's a farce.
Giving shareholders a non-binding vote on executive pay. What exactly does that accomplish? That's like me telling you, Rebel, I don't like how much you make, but I can't do anything about it.
It does at least provide some input from the shareholders. The problem is in our country that the board of directors as an institution is broken. The board is captured by the CEO. We need to reform the board of directors so that it can reestablish its role in hiring, firing, and compensating the CEOs, which it has failed miserably, especially here on Wall Street.
Michael, why do you call it a farce?
Because it's the same thing as the government offering rules for TARP and then telling people that they can't get bonuses or pay, and then we find out that people get bonuses anyway. And it's just not in the financial services sector. We're going through a healthcare crisis, and Blue Cross Blue Shield just awarded millions of bonuses to people while they cut benefits for thousands of their customers. So to make it sound like somebody has some power over you when they don't have any power, it's just a waste of legislation.
Yeah. Okay, let's move on to the next issue in this proposed financial reform bill under the Senate Banking Committee is the Financial Stability Oversight Council. It would monitor systemic risks and make recommendations to the Federal Reserve. Now, make recommendations, what is that? Does that have any teeth, Michael?
No, it doesn't have it. If you give people the ability to make recommendations, but you don't give them the authority to rein things in, don't you think that there's already people within the Federal Reserve and people within the FDIC that have the ability to look at the market and make recommendations, and nobody listens to them already? Or there's people outside of those regulatory bodies that make the regulatory bodies aware of things, and then the regulatory bodies don't listen to them.
Rebel, I mean, what's the point
worse
of giving new powers to a regulatory agency if they're not going to enforce them in the first place?
Well, it's even worse because at least the Fed speaks with one voice of the Fed. Now you're going to have a regulatory agency that's going to have people from the Fed, the FDIC, other agencies, and they all have different agendas, and they're not even going to be able to agree on what they're telling the Fed. So it's a move in the wrong direction.
Let's get to the other issue, the creation of a consumer protection agency on financial products. It would be housed inside the Federal Reserve, and it would have authority over banks with more than $10 billion in assets. Michael, I know that you don't think this is a good idea. Why?
I think it's not a good idea just because of the asset size that they picked, $10 billion. I don't know where that number came from, but the problem with the financial industry in the last 10 years is that the middle market of banking disappeared after 1998 when all of the middle market was gobbled up, and everyone anticipated that it would reform itself. It didn't, and then small business and medium-sized businesses ended up going to Wall Street, and we all know how that worked out, to get their money. So I think if we want the middle market to be back in the power of lending to small business, which is where it needs to be, that middle market business is really up to a $20 billion bank. I don't want to go into the mathematics of that, but it really is at $20 billion. So that number should be higher, and then I might have an agreeable view on that, but I'll turn it over to Rebel's
Is this Consumer Protection Agency going to work?
Putting a watchdog agency in the Fed is like having the Congress be a watchdog agency for the taxpayers. It's not going to work. There is a Consumer Affairs Division in the Fed already, and they failed miserably to protect consumers from predatory lending, subprime mortgages, et cetera. To think that you can create another agency and put it inside the Fed, it's like Michael was saying earlier, you're just moving people around and giving them different titles. Nothing is changing in Washington as usual, and nothing succeeds in Washington like failure.
So bottom line opinion on this legislation, it's probably not going to do anything to fix the banking system, yes or no, Michael?
No, it's not going to do anything.
Rebel?
I think that there are some good parts, especially the reform of the derivatives market and the credit rating agencies.
Okay, thank you both for joining us. We appreciate your insight. Rebel Cole of DePaul University and Michael Iannaccone of MDI Investments. Thank you.